On today's show, 3 questions. Number 1, why are stocks selling off? Number 2, is a recession around the corner? And number 3, so no more BOI? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are. Just the two of us, Rabih.
What's up? How are you?
I'm great. We are officially in that very weird weather in Utah where it's like 60 degrees one day. And then it snowed last night. I was driving to the office and looks like everyone's heading up the canyon to ski. That's where we should be, Rabih. We should be skiing.
I know. Don't get me started, Matt.
Yeah, I know. You're mad at me. I'm sorry. Should we tell everyone our internal fight, our battle?
Long story short.
I'll let you share the side of it.
Long story short, Matt and I had a podcast recording scheduled for when we were supposed to go skiing. So we moved stuff around so we can go skiing. And then Matt comes to me and was like, I'm going to go to St. George with my kids, which is a really good excuse. Like, I can't really tell you no, but also I'm not skiing today because of that. And I hope you feel a little bit guilty, you know?
I really do. So to be fair, I was going to take my kids to Disney World. Yeah, because I'm an idiot. And then it didn't work out this weekend. We don't need to go into that. But then I was like, I got to take them somewhere. So I was talking to my kids and we decided St. George instead, just for the weekend. And so I feel terrible. I really do. I will make it up to you.
You're good. I just like giving you a hard time, you know?
We're going to get up and ski. We're going to do it. Let's jump in. I know these are going to be really important topics that everyone wants to know about because it's been a wild week. Wild week. So let's talk about what's going on with the sell-off, Rabih.
Yeah, I think the last time we had a sell-off this big was back in August 5th, 2024, when like the Japanese carry trade was rolling over and stock prices were going down day after day. And it was like significant compared to the peaceful days we've had before it, type of stuff.
And we know all the listeners remember the Japanese carry trade of 2024. It was a crazy time. We all know that. You guys all remember that.
Of course you all do. So I first thought we're going to talk into the reasons, whether they're political, economic, etc., throughout this podcast. But I thought let's start with actually a survey of performances, because it's been interesting to look what has been standing strong, what has been selling off, and we've been doing it a couple of podcasts. So I got you not only the performance year to date, but also drop downs from their all-time highs. So let's start with performances year to date. We're still where we kind of were last 2 weeks. Gold is at 10.8% for the year. Developed XUX stocks are up 9%. And then you've got emerging markets up around 3.25%.
Yay for diversification.
Yay for diversification. A globally diversified equity portfolio is kind of flat year to date. It's up 0.25%. Then you head into the US, and this is where you see them falling. The Dow Jones is down 0.5 point since the beginning of the year. The S&P 500 is down 3.25% year to date, which is wild because 2 weeks ago it was up 4% for the year. So there's been a 7%, if you do want to do the math that way, erosion of returns in just 2 weeks. NASDAQ is down 5.75 for the year. Bitcoin is down 8, and then small cap stocks like Russell 2000 as an index are down 8.5. And usually when there's an economic slowdown, the ones that get hit most are smaller companies, not larger companies. This kind of gives us an idea where the damage is being made. The damage is being made in the US, and the damage is being made on the smaller companies, not the large ones with tons of cash on their balance sheet, which is interesting to look at.
Wait, and Rabih, you're telling me that Bitcoin is correlated to the NASDAQ? That's so interesting. I would have never thought that. I know. Interesting.
It'll be so interesting to see how Bitcoin fares along a couple of months, because probably now there are economic factors involved that we're going to talk about, but what triggered it was more of geopolitical risk, and what triggered it was more of consumer confidence. And you saw gold rise as a safe haven because of all the uncertainty that was happening. Bitcoin did not actually go that way. Yeah. On the contrary, complete opposite, worst performer. So it's really interesting what it stands for.
Which, does anyone know? We're not going to go there.
We're not. On the next episode.
Next episode. Yeah, save it.
But let's look at them in terms of like drawdown from their all-time high, because that would be interesting whether a certain sector is now in a correction territory, is it in a recession territory, or is it just still a blip, which is interesting. This is a horizon that is a little bit over year to date. It actually extends over the last 6 months because some of them have been dropping before the beginning of the year. But if you really look at developed markets and gold and like a global diversified portfolio, those have dropped less than 3% from their all-time high, which is nothing. Like, this is a blip, this is noise. We need to see a significant drop from their all-time high. The S&P 500, or actually let's do this, the Dow Jones is down 5.77% from its all-time high. So a 5% drop, those happen how long? Every couple of months? Very normal. The S&P 500 is down 7.4% from its all-time high.
From the highs.
From the highs, which were like 3 weeks ago. It's not like from the beginning of the year. Still fine. Not something that causes worry, right? The QQQ Nasdaq is down 10.5%, which is official correction territory.
Yeah.
And then, which is, by the way, interesting. Like, they have dropped 7%, they have dropped 10%. But they have dropped from a position where they were so expensive that they are still kind of expensive. They're not even fairly priced. Like, the forward PE ratio on the S&P 500 right now is still 22, which a long-term average is 16. Usually in booms and really good markets, between 18 and 20. And right now we're still at 22 after a 7% drop.
Yeah.
So purely from a valuation perspective, people would say they might have to sell even more just so they become fairly valued, not even cheap stocks to buy compared to historical averages. But past performance does not guarantee future returns. And for that sense, we do not know whether current valuations are high or low, forward looking. And then comes Russell 2000, which is small caps. Those are down 16% since their all-time high. They've been really taking the hit. And then worst performance is Bitcoin. At its lowest, it was down around 22%, but it recovered a little bit. It's now down 18% from its all-time high. It recovered a little bit because there was talks about a national crypto reserve, and then they backed out.
Did you mention foreign developed already?
Yes, I did, which I said they are much less than, like, foreign developed are down 0.37% from their all-time high. Like, they're flat. They are right now at their all-time high. It's a blip of a day. It doesn't count in the calculation, which tells you that money has been flocking outside of the US towards developed ex-US and towards gold as a safe haven to kind of counterbalance what has been happening in the US. Do you have any thoughts on this before we delve into like economics of it?
No, I think again, I think it's really critical. This is like the epitome of navigating the noise, right? Because if you look on anywhere online, look at the headlines. I mean, the mainstream media, this is where they thrive. They're loving this. They are, as they say, licking their chops, which I kind of hate that saying. I hate that I just said that.
What are chops? No, genuinely, I don't know that word.
They're licking their chops, like their mouth, like they're salivating.
Oh, okay.
Their chops.
Okay.
Anyway,
English lesson for Rabih.
So the mainstream media is going to cling onto this and make it seem even more extreme. And then you see what's happening politically, which we're going to get into, at least as far as economics of what's happening and you know, the worries of recession and all that. I guess I would just emphasize the like, it's really critical, I think, to always take a step back in these moments and look at historical context, just of the pure data, right? Like, forget the politics. Please, let's just push that out for a moment. Just look historically. It is so easy to always feel like this time is different. It's really not. Like, the numbers, the historical data, like we've said so many times, Rabih, to see a 10% correction or a 10% intra-year drawdown happens as often as your birthday. A 20-year correction, 20% negative correction about every 4 to 5 years, and then an extreme 30% plus about once a decade. I guess just to emphasize, like, volatility of these assets is a feature, not a bug. This is the cost of long-term growth. The price you have to pay is the short-term uncertainty and worry. And this is where the money's made. This is where, if you can behave properly in these moments, like this is where the money's made.
100%. I really love that you talked about like the time horizon, because if you were just sitting looking at your account every single day this week, you would have had a pit in your stomach. You were like panicking.
Yep.
But if you really put it into perspective, this is nothing. This is usual course and sticking to a strategy, which is interesting because you said this is where the money is made. And like some people will say, like, what does that mean?
Yeah.
Do I have to sell and wait until it drops and then buy again? No, this is not what we mean. What we
Yeah.
mean is that if you've been saving consistently, this is the time where you double down on your saving consistently.
Yeah.
You make sure that you're not going to forget this week's payment or this month's payment,
Yep.
because you're going to be able to buy them at a relatively lower price, which makes your overall returns much better. You're going to get more return per dollar right now than you would if you had invested a week ago.
Yeah, it's interesting if you just shift your mindset, and we're not saying it's easy, right? This is really difficult. Like, it's scary.
This is why we have this podcast.
This is why we have the podcast. But if you shift your mindset on a couple things, you mentioned time horizon specifically. One of the greatest tools you have when it comes to risk management is having a long time horizon. People don't think of it like that, but if you have a long time horizon, risk really gets kind of worked out of your strategy. You kind of pull it out by having that long time horizon. So if you are, I think most of our listeners are relatively young, have a long time horizon. Like, again, what's happening now? Again, easier said than done. We totally get it. But if you shift your mindset from prices to share accumulation, we focus so much on prices, the value of something. And when you do that, you think the higher the price, the better for you, because you're invested. But it's actually the opposite. If you think about shares accumulate, you think of this as a game, as like, I'm gathering as many shares as I possibly can. Then you're loving this. You're like, oh my gosh, now I can gather more shares. That should be the mindset. The game is gather shares, accumulate as many shares as you possibly can. So then in that case, what's happening right now, if you have that 10, 15, 20 year time horizon, you love this. You're loving what's happening right now.
I love it. I'll leave it there. It's amazing.
Perfect. I left Rabih speechless. Oh my. Oh, it's a good day. It's a good day.
Okay. So let's get a little bit technical because, I'd like to.
Yeah. Because I can.
Because I can. It's it's interesting. Like, if I tell you the US is seeing a larger sell-off than the rest of the world, actually developed are thriving and smaller companies are being hurt more than larger companies, what would you hypothesize is happening economically to, translate into such price movement? Like, what is happening for only the US to being hit? What is the relationship between the US and other countries? And if you really dig down, it's trade. It's straight policy.
Yeah,
right?
it's the tariffs. Yeah.
And this is like, finally, we've been saying that for the beginning of the year, it's been noise. There's no economic narrative. There's no story where you can connect the dots. But finally, it's now showing up, even at the expense of like a sell-off in equities. And what I got you here is some data from the Federal Reserve, as well as the reports that happen every single week. We know that we get like consumer confidence, we've got unemployment, we've got inflation, we've got all of these data coming in every single week, and we try to understand how they turn. But we're not the only people who do that. The Federal Reserve also does. And the Federal Reserve has a tracker called GDP Now by the Atlanta Fed, which is one of the Feds that is out there. And what they do is that they have a daily tracker. Just like you look at the stock market and you see how it's fluctuating every single day, they have a tracker for what they think the GDP level for this quarter is going to be as new days come in and new reports come in. And what is interesting, and I think what prompts and justifies the sell-off that's happening in the market, is that this tracker was before February 20, indicating that the economy for Q1 is going to be growing at 2.3%. Even before that, mid-February, the economy would be growing at 2.9%. But then suddenly, between last Friday of February 28th and today, March 7th, that indicator has completely flipped. And throughout the week, it was estimating that the economy's Q1 annualized GDP growth is going to be a negative 1.5, all the way to now where they are saying that the economy is going to be contracting by 2.4% annualized. It's an annualized term, but this is a negative growth for a single quarter, and we haven't seen that for like a couple of years. This is what actually hints at a recession around the corner, because according to the rule of thumb definition, 2 consecutive quarters of negative growth, and this might be one of them, a negative 2.4 annualized, are a recession in the textbook. So what happened for data to suddenly shift from a positive 2.3 to a negative 2.4? Like, this is not a small deviation in economic activity. It just happened that we had a series of data, and we're going to go through them in a little bit, of economic data coming in, where every single day it was bad and worse. That the metric, the formula that they're using, is telling you we have to look in that direction right now. And just before, because I know we might get into this later, how accurate is this tracker that the Fed uses? What
It's going
they've
to be
been
my
said,
first question. Yeah.
what they have said is that historically they have been off by an absolute term, so plus or minus either way, of 0.7. So even if you incorporate that they have a track error somehow of 0.7 in either direction, the deviation from 2.3 to negative 2.4 is much more than 0.7. So there is something meaningful. And this is where it's interesting. Like, we know we get noisy data every single week, especially from economic reports that could be based on surveys or some accumulated numbers or applications every single week. But regardless, given what we know about how the model performs, this is a significant move, which translated in the market. Before I go into these reports, do you want to talk more? Any questions about like this tracker as a whole?
Yeah, no, I mean, it's just interesting. I mean, I'm looking at the chart right now. If you look at it, it's a precipitous extreme drop off. And to your point, I guess we're going to get into this. You kind of already mentioned it. Is there anything else beyond like the obvious reason for this, which is all the tariffs? Like, is there anything? That's the first thing I'm thinking of. This has to be directly related to what the current policy is and what's happening with tariffs.
Yeah, it is tariffs, but tariffs as a headline doesn't really translate to a certain number switching from one position to another. It has to kind of, I like to use the word of propagate through the economy. An idea of a tariff might harm consumer confidence, which then consumers might decide to stop buying stuff, which lowers retail sales and lowers demand, etc. Like, how does it propagate? And it's so interesting that it could propagate either way. A tariff could, like, there's going to be so many different economic arguments, but until the fact happens, you would not know in which way it propagated. Another way you'd say, oh, tariffs are increasing. Maybe companies around the world are trying to compromise, lower their prices, and this is actually increasing their foreign sales, and that's why they are doing better. So how would you know which economic theory, or I don't know, like the thinking process
Like the chain
leads?
reaction of it
Yeah,
all.
which chain reaction are we taking?
Yeah.
And if you dive deeper into the data, it kind of becomes a little bit more apparent. And let me walk you through them for a second. Here is the data that we received over this week that turned flipped the page on positive growth for the quarter. We got advanced manufacturing, we got a manufacturing index, a construction index, we got auto sales, and we got services index. And those are all business related. So if we think of the economy in terms of consumers, businesses, government, import and export, the one that is fluctuating and the one that made the GDP print become negative or forecasted print to be negative is the business's portion of it, not the consumer. Although consumer confidence is down, if you look at stuff that relate to the consumer, such as the unemployment rate, it's still at 4% or 4.1%. The number of initial jobless claim is still within the range of 220K a month. So we're getting reading on those, and no data point that relates to the consumer has been heading south for us to say negative print in GDP is because of the consumer. We also have the import and export, but the tariff just kicked in like this week.
Yeah.
This is not enough time for us to see a big fluctuation.
And even with the tariffs, Rabih, he's backed off a little bit even more recently about the details of the tariffs and
Yeah,
making some exceptions and all that,
100%.
which we can talk about that too.
So it's there. But the data that we've been seeing is inventories and is manufacturing sentiment. And I'm not going to go into the details of every single report, but a lot of them, especially the manufacturing one, they call a bunch of CEOs especially in the manufacturing industry, and tell them what's your outlook. And they collect this data every single month or
Got
every
it.
2 weeks. And they try to, it's like a poll, but for businesses.
Mm-hmm.
So I think the most interesting one to discuss is US wholesale inventories. And let's take a step back and try to like really navigate the noise. What does it mean when you have inventories? If a business is running as efficiently as it possibly does, the shelves are turning. You are buying stuff and consumers are buying them from you, no worries. If suddenly a consumer demand drops, a consumer does not want, all this inflow will actually stack up and you'll have a buildup of inventory, which is a bad indicator.
Yeah,
But also, if you anticipate that the consumer is going to go wild and they're going to start buying like crazy, like there's the holiday season coming up, you start to stack up beforehand.
sure.
So we are saying that wholesale inventory is increasing. Actually, let me read you this paragraph. Wholesale inventories rose by 0.8% month over month to 906 billion in January 25, compared to an estimate of 0.7 increase. So it was a little bit larger. But this is following a revised 0.4 fall. So what was been happening was that inventories were falling. There was a lot of consumption happening, and then suddenly they shoot it up. Which, if you think about it, this tells us that no, they are not anticipating for anything happening, because what is happening in the next, like in terms of demand, what type of demand event is happening in the next couple of weeks? There's no holiday, there's
Nothing.
nothing. So
Yeah.
the
I mean,
fact that,
well, I mean, there's a couple of, there's the Leprechaun Day coming up.
okay, I'll give you that, across the whole
The
economy.
St. Patrick's. Yeah, exactly.
Across the whole economy, but does it justify an increase of 0.8% following a drop of 0.4? That tells you that there has been kind of a demand shock from consumer confidence. And not only that, this inventory has a source, which is the interesting part. Like, you can build inventory simply by moving, goods from the manufacturer of Kirkland into the shelves of Costco, in a sense. Those are still within the country. But the inventory buildup is happening from imports. So what is kind of showing up, like, there is an overall slowdown, manufacturing is down, etc., but inventories are increasing. Businesses are anticipating that tariffs, which in the chain of the logic causes a supply chain disruption for businesses. They are trying to up buy a little bit of the foreign products before they become very expensive. And if they become expensive while they held them on inventory, they'll make a little bit more profit because of that, because they
Sure.
bought it cheaply, but now the market price is higher. Let's just mark up what we have in our inventory and sell it.
Yeah.
So this is what has been happening. And this tells you that there is not really a lot of investment. The business sector in the economy is kind of at a wait and see position. We know tariffs are happening. Let us do some cost management around it. Try to buy stuff before they get expensive if we can. And let's try to not have our inventory be too big, because we are sowing the seed.
Yeah. So my question on that, Robbie, is or am I thinking about this wrong to say these are interconnected, right? And it's almost like the chicken or the egg thing, where the tariffs are, you already mentioned that, and how it's impacting, I'm going to sneeze, how it's impacting,
Bless you.
yeah, I'm holding it back. I got it. But so there's the one side of it where businesses are anticipating the impact of tariffs. And so you're saying they're stacking how they're going to address, like you're saying, the goods that they're holding and their inventories. Then there's their other side of it. And this is where I'm like chicken or the egg, which is consumer sentiment is, you could argue, or tell me if I'm wrong, you could still argue consumer sentiment is the main issue here, even with the business and like the businesses and the numbers we're seeing there, because they're just anticipating the reaction when consumer sentiment is down. Businesses are going to respond to that, and they're just going to. Is that making sense? Like, does this still all come back to just consumer sentiment's down and businesses are reacting?
Yeah, because businesses are trying to be proactive, not reactive. And this is what they're trying to do. And their own goal is to make profits. And given the changes that are happening, higher costs, especially on imports, they are trying to anticipate that quickly. But there is an other side of it, is that if the consumer decides to not buy anymore, they will have to deal with that inventory. So, and that's why it's showing up as a spike. There are two factors that are increasing inventory, and both of them aren't that good. Maybe one might be cost cutting, the trying to import before the tariffs come kick in. But once they kick in, this means that they're going to be more expensive coming into the country. So
Yeah.
there are two directions heading into the same point, is that higher inventories might not be a good thing, and this has been showing, but the higher inventories is still coming from imports more than it is coming from the consumer. And here's where I have the data point. The same GDP now Fed tracker breaks down the contributors to what causes the GDP to drop down. And what they have, if you look at it, is that usually net imports exports are a negative 0.4, 0.37 contribution to the economy. And why is it negative? Because we import more than we export, and imports are bad, exports are good in the formula. So usually when the economy is growing at 3%, it is, if you exclude imports and exports, it's growing at 3.5. But we say 3 because there's a negative impact from the imports. This is usual cases, what we've been seeing for the last couple of quarters/years. If you look at the tracker right now, they are saying that the impact of the net exports imports, because imports are higher, is a negative 3.8. And if you think of it, if we were up 2.3 and now we are taking out 3.8 because of the impact of import export, well, now we are down 2.5, 2.4.
Yeah.
So it is all coming just from the income, the import aspect, but it is driven by the decisions businesses are making. It's not driven because a trade war is happening and countries are fighting. No, it's happening. The slowdown in the economy is not propagating through the economy because countries are headbutting, not yet, but it is happening because businesses are being proactive, trying to maximize their profits, trying to work around these supply chain disruptions, which is just propagating the message that a slowdown might be coming simply from tariffs and the way the reaction to tariffs has been going through. All is interesting. It really follows the textbook for economics to the dot, because when inventories are high, it's a signal of a demand shock. And a demand shock is usually solved by bringing the goods and supply markets back to their equilibrium, which means you lower interest rates. So this is a textbook path to a recession, where the next step forward would be you'd expect as the slowdown start happening, and we hopefully we don't start seeing it in higher unemployment rate, because that would create a spiral where, yes, the consumer confidence is hit, but now their discretionary spending is hit because they're getting fired, because businesses decided to try to do cost cutting. They tried to import a little bit, but revenue is not increasing, so they might fire people. It all relates, and you don't want it to be a chain reaction down to a deflationary process or a recessionary process. So far, the smoke before the fire is showing, right?
Yep.
To what extent the fire is going to be, how controllable it's going to be, is up to the data as it comes and how the economy reacts. But if you fast forward a couple of years, a couple of months, you would know that this is a textbook slowdown in an economy where we know what the cure is. It's lower interest rates to revitalize the economy. It could also come from deregulation or drafting new tariffs deal, but we don't really depend on fiscal policy to solve immediate problems. We care for monetary policy. So yes, there is smoke or there is clouds on the horizon, but you know that after the whole thing is over, it's not a disease that you don't have the cure for, and we know our way out, which makes your perspective about this whole fluctuation and volatility in the stocks, to bring this to a full circle, something that is a feature, but is not the fate.
Yeah, well, and I think that's a great breakdown, Rabih, and I think hopefully gives people some insight into, like, the numbers are showing like there's some weaknesses here and some things to keep an eye on, as everyone's going to know. If you're sitting there thinking, what do I do next? The answer is nothing. Like, right. This is part of the process. Again, it's a feature, not a bug. But I think the ultimate factor here, we're highlighting the narratives around what's happening with tariffs has had a chain reaction for sure. And it's led to not only consumer sentiment being down, but businesses being proactive and reacting, taking it serious of what's going to happen, and changing their approach, like you're saying, to inventories,
imports,
and
cost cutting.
cost cutting with imports and the demand shock that's there. But the ultimate factor here is, well, this is what makes it so wild, is this could change tomorrow, right? Because, or you tell me if I'm wrong,
Mhm.
but Trump could come tomorrow and say, never mind, we renegotiated deals with Canada and Mexico and China, and all good. We have these new things in place, and we figured it out. Tariffs are gone. That I'm sitting here being like, that could happen. B, if that did, what? I mean, I guess we don't know the answer, but what would be the response, do you think? Or could this, I guess the question is, could this be solved in the short term by Trump just all of a sudden renegotiating these things and saying, oh, this was all just a power?
It's going to be very interesting because, and as we started this conversation, there are multiple economic interpretations that are all valid, but you would not know which one manifests until the event happens, right? But if I want to, throw one out, it would say that now businesses would renegotiate contracts or extend contracts because the tariff impact on the business is like it doesn't affect your day-to-day life as a consumer when tariffs happen. Like if you're not suddenly gonna go, we're still gonna buy something if it's 5% or 10% more expensive. We know ourselves as US consumers, right?
Yeah,
But
we've learned that over the last
we've
few
learned that
years.
over the years. It'll hurt the pocket, but it's fine. On the long run, it'll become more chronic for the economy. But for a business, they are sitting on tables negotiating contracts regarding to their supply and where they get their raw material. And it's kind of, they'll have to unwind decisions that they took that regard the supply chain disruption. How long will that take to unwind, to negotiate a new contract, wait for the new ones to expire, and then go into new ones? So the fact that it'll disappear means that the way it would propagate into the economy, decision making in businesses will have to shift to a less stringent, trying to survive type of attitude to more of like, business is good, let's grow, let's capitalize. So my hypothesis, and I call it hypothesis, is if it ends tomorrow, this would send a good signal because suddenly investors, what I mean by investors, like businesses investing in
Yeah,
the economy, businesses investing in the economy would feel less uncertainty and decide to pump in money to capture future growth. So, and that would reflect in higher stock prices, by the way, because if businesses are investing, like you actually see it, like when they say, oh, Apple decided to do $500 million investment in something. It's
yeah,
like, oh, they're spending money, but the stock price is going up because they're not spending on costs, they're spending on investments that will
yeah,
give them return. So if that happens tomorrow, which kind of makes you, Trump is like forcing you to stay in the market, not to miss the upswing, right? If that happens tomorrow, textbook answer, you would expect stock prices to go back up. But if you are not in the market participating in this, sell off, not that it is good, but you have to, it's the pill that you have to swallow. And then suddenly a decision happens, as you just mentioned, Matt, and stock prices shoot up, you would miss the upside. And we know from history that the largest upsides happen immediately after largest drops
yep.
in stock prices.
These things happen in bunches. Yeah,
Yeah, the stock market may go up tomorrow, and because we're adding an element of the unpredictability of the Trump administration versus any other administration, it doubles down on the argument that you have to stay in the market as much as you can and not deviate away from a systematic approach to investing.
I think I'm just going to call it. I'm going to call it next week. All of a sudden, we're going to get a complete opposite approach to this week, and it's going to be like, yeah, we figured it out. Renegotiated. Tariffs are done.
You have a good track record, and this might hinder your reputation. Like, you broke up strikes, you predicted the Eagles.
We do like breaking up strikes and predicting Super Bowls.
Yeah.
So why don't we just fix the economy as well? Let's do it. No, what we do know for sure is that this wild ride is not even close to over. But we did mention he's already, meaning Trump, has already backed off and has kind of been like, but also we have some, we are doing tariffs, but there's also these exceptions. And I think there's going to be some more of that. I'm no way claiming that I'm an expert in this at all, but I think to me, it feels common sense a little bit that this falls under the category of just negotiation tactics, power plays, trying to force the discussions to renegotiate things. I'm joking when I say I'm predicting this to be solved next week, but I do think this is just trying to get these players back to the table to renegotiate some of these contracts, like, again, between Canada, Mexico, China, all this.
It all goes back to the time horizon. Like, if you really adopt a 30-year time horizon, or let's say a 10-year time horizon, I'm going to be going there. What is happening this week really doesn't matter.
Yeah.
Like, it really does not matter. It is swings. If you are looking at your money going up and down, you'll feel bad. But on the long run, it doesn't matter. It's not a systematic change, and it's like tariffs that could be removed, or a trade agreement that could be amended, or a supply chain contract that could be redrafted. Like, this is the magnitude of it.
Yeah.
We are not saying about a new technology, or a war where there's permanent destruction. This is a blip.
Yeah. Well, and we can prove that, right? Just take go back 5 years, go back 2 years. I mean, you mentioned the Japanese carry trade, August of 2024. I mean, I joke about that, but it's true. Like, go back 5 years and look at the most extreme headlines happening, and literally try to say, like, could you even remember? Now, maybe this isn't a great time to say that because now we're talking COVID, but in reality, it's even more so. Like 5 years ago, look back at the headlines of during COVID. Is it even impacting? Like, do we even remember what was or, does it have any impact of what's happening today? The answer is no. So to that point, Rabih, this is a blip if you extend your time horizon. That was a lot, as always, and great stuff.
Thank you for allowing me to get
We
technical.
love it. We love it. Super helpful, I think, to again help people navigate all of this. Last thing, this will be small, but this is pertinent because we've talked about this so much with our clients, and we've talked about it on the show, and this has been a lot of questions around this. But the question is, so no more BOI? The answer to that is correct, no more BOI. This is directly from the Treasury Department. Treasury Department announced a suspension of enforcement of Corporate Transparency Act against U.S. citizens and domestic reporting companies. So again, this is, I'll just read directly from the release from the Treasury Department. This was on March 2nd. Respect to the Corporate Transparency Act, this is again BOI. Not only will it not enforce any penalties or fines associated with the beneficial ownership information reporting rule under the existing regulation deadlines, but it will further not enforce any penalties or fines against U.S. citizens or domestic reporting companies on their beneficial owners after the forthcoming rule change that affect either. So again, it's dead. They basically have said, like, we're not enforcing this. This is not a thing anymore. You don't have to worry about it. The U.S. Secretary of Treasury, Scott Bensent, said, this is a victory for common sense. So we won't get into the politics of it, but they've basically just said there is no worry. So if you've done it, no harm, no foul. If you haven't done it, it looks like you don't have to worry about it.
So it was a form that you have to file for free, and that's about it. But if you don't, you'll get fined 10 grand, right? Like, that was the whole thing of it.
Yeah,
Do
it's
we
like
know of
$500
any
a day.
business that got fined 10 grand? And I wonder if they're going to get their money back.
Yeah, no. So that's a great question. So they never. So it kept getting kind of kicked. It was kicking the can down the road. So no fines were enacted because they extended it. There was a lawsuit, I believe, out of Texas. It's always Texas, it seems, that has the lawsuits. But it's like always the extreme stories. Like, man, out of Florida, the lawsuits always come out of Texas, it feels like. But they held it up with that, and then they. And I'm trying to remember all the timeline, but that held it up. So they kind of pushed it off. And then they instigated after they figured all that out. They said, nope, it's back on. And now the Treasury Department came and put the death nail in it and just said, nope, this is over. So could it change again? Sure. But it looks like it's, for now, no need to worry about it. So we're sorry if you took the 5 or 10 minutes to do that and you were stressed about it, but we still feel like it was the right move to at least do it just in case. But again, for now, don't have to worry about it. So Rabih, that was awesome.
Thank you.
You mentioned the Super Bowl. I'm still riding the high of the Super Bowl.
Well, I think it's fair until the season starts, you know?
Yes, I'm still riding that high. And speaking of the Super Bowl, I've heard there is basically the Super Bowl of dental events happening in June. Some
Wow.
call it that.
This is a
Yeah,
new trend, Matt. Wow.
some call it that. Not me, but there have been people who have referred to the Dentist Money Summit as the Super Bowl of dental events. So you should.
This might be the best transition you've ever made.
But again, I'm not saying it, Rabih, but there are people out there that have said it.
You caught me
I
off
think
guard.
maybe that's my only goal. But we would love to have you out to the Super Bowl of dental events, the Dentist Money Summit, June 20th and 21st in Park City, Utah. This is our second annual full new slate of speakers. It is going to be amazing. We are very excited for it and would love to have you out there. Again, we're not pulling the whole like it's selling out, but we did get an update from our team, from our very own Spencer Chipping, who runs the whole thing. He's amazing. We are definitely ahead of schedule from last year. There is definitely a chance it gets sold out. So if you have any interest to come meet Rabih, the great Rabih, and the Dentist Advisors team, and be there with like-minded dentists. We would love to have you out there. I think you'd get a ton out of it. June 20th and 21st, Park City. Go check out dentistmoneysummit.com. For now, Rabih, as always, thanks for being here and sharing your wisdom. Everyone, thank you for listening. That was our 2 cents. Till next time. Bye-bye.